And welcome everyone, Story Trading special presentation today. We have Mark Gomes here. He's going to give us a presentation on asset allocation and portfolio management strategies. But first, a disclaimer: Story Trading, nor our guest presenters, nor myself, are investment advisors. Investing in securities involves significant risk of loss. This event is being recorded and will be shared on social media. A little bit about Story Trading, if you're not familiar with us, we're an investor network where we aim to beat Wall Street insiders at their own game through crowdsourced collaboration on our 4 pillars of fundamentals, catalyst, sentiment, and technicals in order to understand the story behind the trade. And we also give access to our Zoom events for an extra edge. Most of our events are for VIP members only. This one is a free preview. Before we get started, I want to give a quick look at our performance. We have VIP picks at our Zoom events. If you go to storytrading.com and you click on performance, right, went to a different screen. All right, you're going to get this tab over here, so you can check on the performance of our presenters stock by stock, and there's a tab here that we group it by presenter. So that's something you can take a look at over on our website. And with that, we're going to turn it over to Mark Gomes.
All right, great. How you doing? So
before Mark, you get started on today's topic, first of all, just want to let people know your website. They can find you at markgomesstocks@wordpress.com. And if you can, before talking about portfolio management, if you just give everyone a little bit of information about your background and your experience and your success and your credibility in this area, that'll be great.
Sure. And it's markgomesstocks.wordpress.com, 2 S's, and it's Mark Gomes, Gomes stocks, STOCKS, .wordpress.com. You can find me in other places you guys already know. So as far as my background, I first got interested in stocks back in 1986. So a little while ago. Went to school for finance, among other things, finished with multiple degrees, and finished with honors out of Northeastern University there. Went on to, luckily got put into a technology research company by the name of International Data Corporation, IDC. You can look them up. One of the world's preeminent analytical firms on technology, where I was illustriously making photocopies and sending faxes out to Wall Street analysts. Eventually becoming an analyst myself, though, and moving on to AMR research, which was much more specialized in terms of not just what the vendors were doing, but what the users of technology were doing, which gave me the great platform of understanding what is really important to make a technology company succeed. And it's not the story, unfortunately, not just the story, obviously, right? It starts with the story, but then it goes to execution. So that's where I come from. It's a deep, long history of understanding research, understanding equity valuation. I did go through the CFA program. I've had mentorship for many years, and eventually started listening to guys that have gotten rich, and in doing so, kind of synthesized a methodology that encapsulates everything from the best people I've ever known, plus some additional things that have enhanced that learning. So hope that's a decent start. Anything else you want to add to that?
Great. Yeah. What I want to add is that you've been a very important part of our community for the last couple of years with the research we've been doing in the WhatsApp groups and on some of the Zoom events. And, a lot of us have grown with you, have learned a lot. A lot of people in our community have made a lot of money. And I think there's probably several people now with 7-figure portfolios, a couple people with 8-figure portfolios. Yeah. So, you're definitely a large part of helping achieve that. And, I think that's why it's kind of a different strategy. As you accumulate more wealth, you have to manage your money a little bit differently. And I thought, that's why it was important to have this event here with you today.
Great. Okay, so we'll jump right in then. There are 3 main pillars I would consider when it comes to managing a portfolio. And you made a great point That'll be part of the first pillar, which is the number of positions that you'll have in your portfolio. Pillar number 2 is the sizing of those positions. And then the third pillar is the management of those positions. Okay, so I'll start with what you said. Okay, and pillar number 1, in terms of determining the number of positions that you are going to hold, one of the things that determine that, or should determine that, is your net worth. Okay, so if you have a smaller net worth, if you're, and more specifically, if you have a smaller portfolio, all right, you're starting out with a couple $1,000s, but you have a $80,000 a year job. Well, clearly you're going to be able to make your portfolio grow a lot faster by taking a chunk of your salary, of your pay, and putting it into your stock accounts than the actual capital gains of the stock account. If your $2,000 becomes $3,000, well, you might throw $5,000 into your account over that course of a 12-month period. Okay, so in cases like that, you can very much afford to, and I'm not going to say the word recommend, but I certainly would myself concentrate that $2,000 in perhaps 2 stocks, maybe even 1 if you really want to go at it that way, because you're not risking much in terms of your future net worth. Okay, so keep that in mind, because what happens is, as you grow now, let's say you start out with 2,000 in 1 stock, and let's say you choose a good stock, and in the meantime, you're saving more money. You throw another $5,000 in or whatever, and you say, okay, I'm going to buy another stock. Now you've got 2 stocks and one's done well. Maybe you've got $5,000 in each of 2 stocks, and you've got a $10,000 account. You can start collecting stocks kind of like baseball cards. You know, the next 5,000 can go into another stock, et cetera, et cetera. It's kind of like that. But you don't want to spread yourself too thin while your net worth or your portfolio is still relatively small. But as you get larger, you definitely want to diversify. Diversification is great for one main reason, and Ray Dalio said it best. If you can find 10 companies, all of which you believe have a great chance of tripling in value with relatively low risk, it is far superior to spread your money out across those 10 stocks than to put it all into the one that you think is going to work the best. Because if you're wrong with the one, you get destroyed. But if you're wrong with 2 or 3 out of 10, you make a lot of money because the other 7 or 8 were really floated the boat. When you think of a baseball team, you know, if 7 out of the 9 guys in the lineup have a great day, your team's probably winning the game. Okay, and that's the way you want to look at that. So you know, your net worth and the size of your portfolio will determine the amount of risk that you want to take. And yes, the fewer number of positions you have, the greater the risk, assuming that you've done the proper amount of research on each name. Okay, and so that's the last bullet point I'll put on this first major bullet point. The number of positions will be based on your net worth, the size of your portfolio, and your ability to vet ideas properly. You don't want to have 10 different stocks in your portfolio if 8 of them haven't been researched properly. Okay. Now, what does research properly mean? That's a subject for another day. But in short, you really want ideally to have expert analysis of what you're investigating. Now, you might be the expert yourself. If you're a biochemical engineer and you're investigating some biochemical stocks, great, you're the guy or lady for that, right? But I have all my contacts, most of my contacts are in technology because I came up as a technology consultant. I can call any number of people on various technology companies and figure out, no, that company has really crappy software. They get a lot of complaints from customers, or this software is crazy, it's taking over. They're taking accounts from Oracle. I know a lot of Oracle accounts that are switching over to Workday. This was a real case a few years ago. And I invested in Workday simply because I knew from my contacts that Workday was stealing accounts from SAP and Oracle. That's valuable. Okay. A biotech stock, I don't have much contacts. And so I kind of stay away from biotech stocks because I can't have the level of confidence that I can build in a technology stock where I can build tremendous confidence, almost to the point of omniscience knowledge. Okay, so we'll leave that at that. So that's how you determine kind of the number of positions you want to be involved with. So that takes us to pillar number 2, position sizing. Now, number 1, and this is something that you'll hear almost unique to me. I don't hear this in a lot of places. The way that you size your position is going to be primarily based on how risky the position is, not how much reward it can get you. And if you think about it, it just makes common sense, because the company that you think could be a 100-bagger can probably also go bankrupt. And that's often the case. We had that last year when COVID struck, when we picked stocks like David's Tea. That was a company that, you know, people perceived as having a chance to go bankrupt. Summer Infant, you know, there was perceptions of bankruptcy risk. Okay, so in those cases, those were not stocks where I put $1 million into those stocks. I put a good amount of money in because of the level of confidence that my team was able to ascertain as far as them not going bankrupt, using experts, Wall Street experts on bankruptcy, right? To figure out these guys are probably not going to go bankrupt. So we had confidence there, but not so much as to make it a Smith size position or a Tech Precision size position where bankruptcy doesn't seem to be even something that will be discussed anytime, you know, in the foreseeable future. Okay, so the level of risk that you're taking, how much you can lose on a position, is what you really want to focus in on, not the excitement of how much I can make on it. Because if you're good at investing, you could take your time. Okay, I take my time. I don't go hog. I don't try to make 200% a year. I can. I think if you put a gun to my head and say you make 200% a year this year, or you're going to die, I'll do it. No problem. Okay. But the amount of risk that you take on trying to accomplish that is not smart, particularly as you get up to a certain wealth level, and particularly when you get to a wealth level where you have enough money that you say to yourself, you know what? I'll be okay for the rest of my life if this is all I have. Okay. After that, it's gravy, and you don't want to be greedy with gravy. All right. So that's what I really focus in on. So now, how big should the positions be? Well, of course, that will be determined by how many positions you take. So a lot of folks, I like, as a rule of thumb, I love the number 10. It's just a nice round number. If you think, you know, I think for many, many types of people, 10 would be a solid number. I have more, okay? But a lot of those positions are not what I would consider core, you know, really important. When I really, if it gets to a point in the time of the market like it is now, where I get rid of tertiary positions, I could probably count 10 names where I feel really, really strong about those names. Okay. So, well, 10 divides into 100% into 10% each. Okay. On average. So if you were going to choose to have 10 positions, you would average 10% per position, but that's the average. Some of those positions will be smaller because of their higher risk, and some of those positions will be or lower because they're higher risk, and some of those positions will be higher because they're a lower risk profile. And of course, from there, you want to determine the risk versus the reward, right? So a company where I can lose 20%, that's the risk, but make 100%, that's great. I know that's a 5-to-1 risk reward ratio. But if there's another stock where I can lose 20% but make 200%, then obviously I want that position to be larger. Okay. I don't want that to be a real qualitative. I don't want it to be the stock that I love the story the most. It's the one where I've done the math and said, this is really how high I could go, and this is how low it can go. And that's how you determine position sizing. So if you have any questions, hold them on that, right? And Benny, if you want to stop me before I go to the third pillar, we can elaborate.
No, I'm taking notes. This is all very good. Keep going. I'll have a couple questions at the end, probably. Ken.
Great, and we'll have time for Q&A because we're on the third pillar, and the third pillar is perhaps the easiest of all, and that's management. Okay, and how do you manage those positions that you've already put in place? Okay, there's two things you want to do. One, you want to stay up to date. You want to stay abreast on the story. you have an idea that the stock you've invested in is going to be worth more in the future because X, Y, and Z. Excuse me.
Bless you.
Thank you. And you want to make sure that X, Y, and Z are happening. Now, things don't always happen as fast as you might expect. Okay. That's okay. As long as progress is being made towards that end, not excuses. So there's a difference, right? We're at step 1 and we want to get to step 10. Okay. And you think we should get to step 5 by a certain period of time. And, you know, an earnings call happens or a management call happens and they didn't get as far as you expected. That's okay as long as they've made progress towards that goal. If they haven't made progress towards that goal and just said, things, you know, are just taking a little longer than we thought, we'll get past step 1 to step 2, you know, soon enough. And you know, fool me once, shame on you. Fool me twice, shame on me. We won't get fooled again. So that's one thing where you want to really stay updated on the company and what they are trying to accomplish and how to delineate between lip service and progress. Progress being a little slower than expected is okay. You do want to adjust your expectations in terms of when I'm going to have my reward, but don't let that be, don't let excuses replace progress. Okay. So that's one thing you want to do and learn in the process. Learn how to do better and better research. Learn how to become a professional investor. Learn what professionals do, and get better as an investor as you get older and more experienced, because as you gain more and more money, that becomes more important. The second and last point when it comes to management is a lot of you know I have a risk reward methodology. Okay. And what that is as at the beginning, you have an idea of how much money you're risking and how much reward you can have. Well, there's progress towards a goal. So let's say you have a stock that's at 10 that you think can go to 20 by next year. Well, you could draw a line, you could draw a chart on a piece of paper where today, right, you draw 10 and you put a dot there. And then across on the other side of the piece of paper, it is 1 year from now, March 10th, 2022. And on that point of the paper, you put $20 a share. Okay. And you draw a straight line. Okay. On the piece of paper. That's what you think the chart should look like in a perfect world. Okay. 10 now, 20 here in the future. Well, of course it doesn't happen that way. Okay. If God was in charge of stocks, that's what would happen. Every stock would move slightly every single day towards its goal. And that would be a one-dimensional chart. All charts would look like this. Some would be steep like this, some would be like this, but they would just go in a straight line towards where they're moving towards. That doesn't happen. What ends up happening is you have a channel. And you're all familiar with this. Stocks bounce up and down within a channel. And hopefully you have a good stock that's moving up and down in an upward sloping channel. Okay. Well, in that channel, you have highs and you have lows. Okay. And we're all familiar with that from the concept of technical analysis. But from the standpoint of fundamental analysis, what's happening is if a stock moves very rapidly towards the high end of that range, right, you can reassess your risk and reward. Because if you thought you were risking $2 on that $10 stock to make $10 profit for it to go from 10 to 20, right, your risk reward is 5 to 1. But what happens if tomorrow, for no great reason, no real major change in your thesis or thinking, the stock goes to 15? Well, now you've got $7 of risk for the stock to go down to 8 versus 2 when it was at 10, and only $5 of upside. The risk reward has changed. Okay, so you might want to think, and by the way, your position size has just increased by 50% because the stock just went from 10 to 15. So you might want to think about, and you don't have to do this, you might want to think about taking some off the table at that point in time, particularly if you're at the top of the range and it happens quickly and you don't think anything material has changed. That's the big point. Okay, if something major has changed in the company's fortunes, that's a different story. Okay, but otherwise, you have to keep an eye on your risk reward, and using a risk reward chart can help that. I've done numerous videos and blog posts about that concept. So that's important to learn. And that pretty much does it. So between figuring out how many positions you should have at any point in time, and that will change as you get richer, the size of each position and your management of those positions sets you up to be a very good manager of your portfolio over time.
Perfect. Thank you, Mark. Very clear, simple concepts. I do have a couple questions regarding the channels. I think a lot of people understand that in terms of basically you're buying low, selling high in terms of the channel. But I think what gets a lot of traders or investors is that when it's at the bottom of the channel, I think there's some fear of what if it now breaks the channel? There's a risk that when it's at the bottom, it can break the channel and form a new bearish channel from there. And the opposite, it gets to the top of the channel and you have some excitement. Oh, the news is so good. The fundamentals are good. The catalysts are good. It might break above this channel and create a new channel that's on a steeper slope. Like, how do you combat that way of thinking?
Right. Well, and that comes down to being a great investor in terms of having a professional approach to the fundamentals of the company. Okay. Because most people don't do this. And as a result of that, you can have situations where your risk reward chart breaks. In my world, there's no such thing as that. Okay. A risk reward channel is different than a technical channel. So if the technical channel breaks, a lot of people might filter out because technically the stock is broken. But is the company broken? Is the company broken? Are the fundamentals broken? That's what you have to ask yourself, because and if you're on top of the company, and I just saw this happen with SMSI the other day on I have 3 risk reward lines kind of drawn. And the last one, the shorter term, the ones are more technical than fundamental, but I have the super long term one that goes back to 1995. 2 big broad lines. Okay. And the top of that line is probably at $80 a share or something crazy like that. And the bottom of that line is something equally crazy, like $1. And as I zoom in, right, on what this company has looked like since 2017, there's a more well-defined channel, and it's been mostly within that channel. And there have been times where I drew the lines wrong and the stock broke down underneath that line. Now, what will intuitively happen, and this is where your point is great, Ben, is usually a stock will be at the low end of the channel when people are most fearful. Okay. And our advantage as professionally minded investors is to know through our research, through our homework, that there's nothing to be fearful of. Nothing's wrong with the story. It's just there are bumps in the road, ups and downs, delays, and things like that. Sometimes things happen faster than we expect. Sometimes they happen slower, right? Usually slower when it comes to stocks, because stocks are companies. And you all work for a company or yourself. And how fast and dynamic is the company that you work for? Things don't change every day at the water cooler, every week, every month, even every year. So why do we expect the companies that we're invested in to be any different? Things don't change that fast. Things don't move that fast. So my take is, if a company that I'm invested in is heading towards the low end of the risk reward channel, I'm doing a little extra work to make sure that everything's okay at that company. I don't want to necessarily double down, right? I'm so confident in this company, I'm going to double down. You can't do that because you're not always right. All right. That happened with APT. I put together a great whiteboard. It's the famous whiteboard everybody knows about. This company looks like they're going to make this many dollars per share. And guess what? Doesn't look like that's going to happen. Right. And as a result, we had a round trip where the stock went from 10 when I talked about it to 20. And now it's back at 10 again. And if you just went for that whole ride, you made nothing. But if you took the risk reward principles up at 20, you took your profit off the table. And even if the rest of that money dropped down to 10, you're still at a profit despite the round trip. And now we are at risk reward lows where you can make a determination of whether everything is moving according to plan or not. In the case of APT, it's not. In the case of SMSI, it is. And that's where you can say, okay, we're at a risk reward low. Let me take my position size back up. Why? Because as the stock has come down from the risk reward highs and you took some money off the table at the top, think about it. If you put in 1,000 at 10, you went to 2,000 and you took 1,000 off the table and put it on the side. Now you're playing with house money and the stock drops in half. Well, now your position size is half of what it was originally. You could take that profit took off the table and double your position size. Now you're back to your original position size, but you still have 50% profit sitting on the sidelines that you're never going to lose because that's in cash or moving into another position.
Great. So to summarize in a few words, it basically research is what gives you conviction in the bottom of the channel and the top of the channel. So when it gets to the bottom, you're not going to be fearful because you did your research and right. Okay. Sounds good.
Yeah, and being true to yourself and being honest with yourself, right? When the AP came out and they gave guidance for next year, that was kind of a wake up call. Hey, we're not going to do $4 next year. Oh, okay, we're not going to do $4 next year. Then why? And everything, they're talking normalization. Okay, the story has changed a bit, although there's still value, right? Now the valuation is nice, but it's not an exciting story anymore. So, do I want to rush out of the stock at 10? Not necessarily, but do I want to buy more? Definitely not, kind of deal. But when it happened with SMSI, and then especially the news came out, with the earnings, I was buying in after hours because I saw everything's going great and the stock's at the low end of its near-term risk reward channel. And boom, we get a quick 20% pop from there. Beautiful. Easy.
Awesome. I got a couple more, but I'm gonna pass it off to my colleague Rob Mock to see if he has any questions first.
Yeah. Hey, Mark.
Hey, Rob. How's it going, buddy?
Very good. How are you?
Great, thanks.
So one of the questions I have is how do you factor in like the tax implications instead of just like buying a stock that is fundamentally worth like more money in the future and just holding it? Or do you trade it when it gets a peak to the channels?
Yep.
How do you handle
that? You definitely want to consider that, right? And a lot of it will depend on the volatility of the stock, right? So if you've got a company that has a great deal of volatility from 10, 20 to 25 to 20 to 30 kind of deal, you want to kind of do the math and say, well, geez, if I hold and get past 1 year, now I have long-term capital gains tax, and you jot that down, right? And then you say, well, if I buy and sell at highs and lows, okay, I got to pay higher taxes, but there's a good chance I make more profit. You have to take that into account. A lot of people will tell you that it is, if you believe in the company's going, from 10 to 30 over time, just hold it and don't play around. Okay. And that in many cases ends up being wise. I'd say, we call that getting cute. Trading the stock back and forth is called being cute. And being cute is not easy. You really, really have to become good and disciplined at that risk reward methodology to play it. Otherwise, I personally think it would be better. And in hindsight, this is my experience, having been in the market for 30 years. My experience is that until I became really, really good at this, I was making horrible mistakes. I would have been much better just buying and holding in my early years. Much better.
Yeah, that's one of the reasons I asked the question. For newer traders, if they see a good company, just buy it and probably hold it.
Yeah,
it's rough to try to like figure out when to buy, when to sell. Your emotions kick in and usually make you make the wrong decision.
Yeah, the one thing I will say is, let's say you are within striking distance of switching over to long-term capital gains, and you determine fundamentally that it's really time to get out of the stock. That's the one time where historically I've noticed that that's not being cute. That's making a decision, right? And if the decision is it's time to exit out of that stock, I have regretted holding on, trying to say, okay, well, I'm only a month away from long-term capital gains. Well, guess what? Those long-term capital gains can evaporate in that 1 month time. So it's better to pay 40% now on something than to pay 20% on nothing. And that's the only thing that I would consider otherwise.
Makes sense. Thank you.
Yep. Yes, sir.
Great, Mark, I got another one for you regarding sizing. What I heard from you is that your sizing should be based on risk, not reward. And that makes sense if you're thinking logically, not emotionally, right? Now, the problem is, I think a lot of people, myself included, and I observe it right now in some of our research groups, is I think a lot of people do their position sizing based on how much they think they know about the stock. The more omniscient they feel about the stock. So, well, I know everything there is to know about this company. I'm going 50% in, or I'm going YOLO, right? I know everything there is to know about SMSI. I've made that mistake. I think I continue to make that mistake. But there's one situation where that I've experienced that maybe could be a cure to that, and I was wondering your feedback on it. I once traded in altcoins, cryptos, for a while with great success. I don't do it now because I don't have time. But basically, the thing here is I didn't know anything about the cryptos. It was all like a gamble to me. So because of that, I developed this strategy, which I'd never even read about, but just almost naturally. Because I didn't know what the heck I was invested in, my asset allocation was simply based on how the asset allocation itself changed over time. So if I started and said, here's 10 cryptos, 10 altcoins, and I put 10% each in it, and a week later, 2 weeks later, I see one of them's at 50% allocation. I'm like, well, I don't even know what the hell I'm holding. Let me cut it down, go back to 10%, right? And then I did the reverse work too. I got something went to 2%. I'm like, all right, well, maybe it's cheap now. Let me buy it back up to 10%. And then I discovered over time, I was naturally buying low and selling high just through this asset allocation method, which again, I did almost from a weakness point of view because I had no idea what the hell I was holding. So it can sometimes work against you when you do so much research and you know everything there is to know about the stock. You can sometimes go haywire with your allocation. So I was wondering what you think about this pure asset allocation method, which is kind of agnostic to fundamentals and knowledge, really.
Well, in that particular case that you gave me, you had equal knowledge of each position and you had equal risk in each position because cryptos, what is the intrinsic value of a crypto? There is not one single crypto that has an intrinsic value of anything above 0. Okay, intrinsic, that's key. What's the intrinsic value of Michael Jordan rookie card? Also 0. It's a piece of cardboard with a picture on it. But if it's in perfect condition and it is an authentic Michael Jordan rookie card, you can put it on eBay for about $1 million right now, right? Ditto, a Bitcoin has 0 intrinsic value. You can't do anything with it. You can't eat it. You can't form it into something, right? But it has an intrinsic value of, about $50,000. A real value, a world value of $50,000. So, what you were dealing with was a bunch of assets that all had the equal level of risk, 100%, an unknown amount of reward. So, if it's question mark over -100 is all the same. You had it all the same. So that's where that works. Now in the stock world, where you're dealing with companies, so there's intrinsic value. It's a real entity that generates, revenue and hopefully profits, and more over time. The risk is determined partly with what if I'm wrong. It's as simple as that, right? You do your research, right? And you determine that the research gets you excited. Here's how much I can make off of this thing. The risk comes in on, well, what if I'm wrong? What if things don't work out? So that's where the research really comes in.
All righty. Thank you for that. I think, Rob, you have one more before we open it up for Q&A.
Do you ever play calls or puts?
Oh yeah, all the time. But I almost never buy calls and or puts. I think calls and puts can be great at major inflection points, right? So in particular, when a stock reaches a risk reward low, if there's a lot of volatility in the stock. So in other words, if the premium on the options is juicy, I want to sell those options. So at risk reward highs, if there is juicy premium, so a stock at 10, that same stock that I said at 10 that shoots up to 15 and people are hyped up, it's going straight to the moon. I'm willing to pay $3 for the April 20 calls. Gimme, right? And so now what I've done is by taking in $3 for the April 20 calls, right? I've eliminated a great deal of my risk. So now I can either sell less at 15 of the stock or not sell any at all, right? Because I just put $3 in my hand, right? And what that's done is taken a lot of risk off the table, right? The whole idea of buying and selling at risk reward highs and lows, or just reallocating your position, is to get your risk of your entire portfolio back in line. Well, if you take $3 off the table by selling a call option at a risk reward high, well, the stock can come back down to 12 and you haven't lost a thing, because that $3 option that you sold is going to go to 0. And so now it's a free ride down to 12, and at 12 you don't feel so bad, because okay, well, now we're back at 12, it's only $2 above 10. That makes sense because the stock should make progress, and I'm good, right? So I'm oftentimes selling calls at tops, especially when the premium is very juicy. Opposite at the lows, when the stock reaches a risk reward low, stock gets, let's say the stock comes back down to 10 quickly from the 15, right? I've just banked $3, beautiful. But the news that came, maybe there was some news behind it, maybe it doesn't justify a 50% move, but he was like, this is progress, this is great. And you feel better about the company. I wish I'd bought more initially when it was 10, and now it's back down to 10, and maybe I want to buy more now, and the story hasn't changed, but people are willing to pay you $3 for the April 10 puts. And for those of you who don't understand what I'm saying, just jot this down and then look it up in Google, so you can learn what this all means. If I sell the April 10 puts for $3, the worst thing that can happen is I'm buying the stock for $7. But what's more likely is the stock goes back to 12, 13, or 15, and those options become worthless, which means I get to keep that $3 of that option, that put that I sold. So I get to make money in between the lines all the way up. And the best situation is if the options are juicy on the up and on the down, and I never have to sell a share. And all along the way, I'm just banking on selling calls at tops and selling puts at highs. At lows, boom, boom, boom. I make 6 figures a year very easily just selling calls and puts. And basically what you're doing is, like, people who buy options are gambling on something specific happening in a specific time frame. That's a very difficult game. That's an even more difficult game than trading stocks itself, right? So I consider that gambling. And gambling is something you do in a casino. And who makes money at the casino every single day? The casino. So by selling options, I'm effectively the casino. All right. Now, and it has to be with stocks that I really understand and that I'm really willing to take responsibility for what ends up happening if. So, if the stock goes to 20, I have to be prepared to give up the stock. And if it goes down to 7, I have to be prepared to take that stock in and accept that I have a $7 cost basis. So I'm not really gambling, right? I'm playing casino to the gamblers, but at the same time with something that I actually want.
Yeah, you're the house. That's fascinating stuff. The key is not being greedy. The irony of it is if you're not greedy, you make more money than people who are. But that's we could always have a conversation specifically on that later. Actually, I had one last one before we open it up. At what point, we've had so much success within not only the story trading community, but also you have your own community and blog and a chat room as well. So between our two networks, a lot of people have made a lot of money on some of the picks that we've had. So it's very, difficult to say let me just, take the winnings from one microcap and then go into the next one. That's very easy to do. But at some point, it's probably wise to set aside that money and put it in something safer that you never have to manage, some sort of mutual fund, something very low risk. How do you manage that? Do you have a rule of thumb to say how much money is in the safe money and how much is in the actively managed microcap money?
Sure. There's two things, and that's an awesome question. That can be the fourth pillar, actually, that we can add to all this. So what happens as you gain more and more wealth? So there's two things, right? Number one, you look at the long-term risk reward lines of the stock market in general, okay? And there are different points in time where, so I'm looking at the stock market in general right now, and I pull out a chart, and that's what you see me doing right now, just so I'm visualizing it as I'm talking to you guys about it. I see that we're at risk reward high levels that we only see, once every several decades, okay? That doesn't mean I want to pull all my money out of stocks, right? But it does mean I want to lock in some of my net worth. And by the way, this actually ends up being a natural thing, because at risk reward highs, when the market itself is at a long-term risk reward high, I have a harder time finding companies that I think are attractive. During COVID, it was easy. I was looking at names, I was like, oh my God, risk reward, great. Oh my God, the risk reward was phenomenal on so many names. And I wanted to just pour my money into each one because I was finding so many, but I'm not finding so many now. So by natural selection, right? Now think about this. If my number is 10, the number of stocks I want in my portfolio is 10, but I can't find 10 stocks, well, guess what? The rest of that money sits in cash. I'm not going to change my number from 10 to 5 just because I can't find 10. I'm going to put my average of 10% in each of those 5 stocks, and then 50% of my portfolio is going to be in cash. And that's where you can say, let me allocate this to something safer, whether it's the bank, cash, real estate, what have you, right? And wait for more great picks to come about. So that becomes very easy, right? The second part of the equation is not, so we talked about the market being at highs and being it harder to find attractive positions. Don't force it, allocate that money, keep that money in cash or put it elsewhere. Is as you get to a certain level of wealth where you can no longer reasonably find places to put that money. Okay, so what's happened with myself is that the kinds of stocks that I'm good at picking, right, where I can get an advantage. I can't get an advantage on Intel, for example, right? My advantage is on smaller companies in the technology realm. And it's always been that way. And it's always a similar market cap range. But what happens is you get bigger and bigger and bigger. Back when I was putting 2,000 into a stock, I could hit the buy button and boom, I could hit the ask and no problem. I have my full position. But now, right, a TPCS comes around. If I want to have a 7-figure position in TPCS, it's going to take me weeks or months to build that position. Okay. And when I'm done building that position, let's say, if 10% of my net worth, I do the math on TPCS, I'm like, oh, that represents this big a percent of the company. I don't want to own 20% of a company, right? And certainly beyond 5%, you got to file with the SEC. I don't want to do that sort of thing, right? And there's a limit to how many companies I can find that meet my criteria. And there's only so much money I can put into each stock. What do I do with the rest of my money? Well, I buy a bigger condo. I have a representative at UBS who I grew up with in the industry, and he's great at finding me new investments. So I'm investing in hedge funds that are run by people that used to be my customers and things like that. Okay, so that's how you handle that.
That's fascinating. I want to add that, everything you described takes a lot of experience and education. It's definitely harder than what you're saying, because when you bring up this topic of valuations and you can't find anything that's attractive, well, what happens very often at market tops is that analysts, Wall Street, the media, everyone starts talking about relative valuation. So everything all of a sudden looks cheap. right? Because they're looking at Zoom and Teladoc and Tesla, right? And now they're saying, well, the whole rest of the market looks so cheap now. Look at the revenue multiple, or they may look at companies that have no revenue. Look at the market cap versus the total addressable market. So I think a lot of people get sucked in because of that. And then look what happens all of a sudden. We had a correction the other day. Teladoc comes down 40% peak to trough. And guess what? So does Dario, Dario Health, because of that relative valuation game. So it's
so
easier said than done, man. It is.
No, it's not.
That's where the DCF valuation comes into play.
Bingo, exactly. And this is the thing that you see here, right? Is that, and you're right, because you got, GKOS is trading at like close to 20 times revenue. And so the relative valuation on IRIX is $70 a share, right? That's great if people want to feed into that and drive the stock to $60 a share, $70 a share, beautiful. But in the meantime, the DCF is the real, that's the gold standard. It always has been. If you don't understand DCF, the first thing that you want to learn is, how do I figure out how to do a DCF? And yes, that is not easy, because you have to learn financial analysis, income statements, balance sheets, cash flow statements. And then you got to take all that knowledge because you need cash flow to figure out what a discounted cash flow is. And yes, that is daunting. But if you want to be a multi-millionaire making 7 figures a year, it's not that hard by comparison. The alternative is for me to grow, an extra 1.5 feet and learn how to shoot basketballs really well. It's not going to happen.
All right, Mark, we got 13 minutes left. I want to open it up to the floor. If you have any questions, either put it in the chat room or raise your hand. There's one that already came in to chat here by Daniel Sequeira, it looks like. He says, hi, Ben, Mark, Rob, and everyone. I recently joined this group and I've learned a lot already. And he goes on to say, what is your opinion about the professional research analysis offered by online trading accounts such as Fidelity and Chase? And the reason he asks is that many times he finds that the information they provide is in conflict with the research that we're providing, or the collaborative research we're doing here.
If you could see my face, it's garbage. It's garbage. It's funny because the regulators a long time ago wanted to protect the investors and the amount of fees that we're paying for commissions and Wall Street and blah, blah, blah. So they put these rules in place where these firms had to put a certain amount of money aside to provide research to investors, both retail and institutional. Now, the funny thing is that it was, at the end of the day, what they actually put in place was enough to make it seem like they cared, but they didn't care. They just wanted to shut people up. It's garbage. It's absolute garbage. You can't, and a lot of what you see from sell side firms is garbage too, because a lot of these firms, and I won't name names, but there are definitely sell side firms whose research comes out, and I don't pay it any mind in terms of your price target, and all that, because I know that all that firm is trying to do is get investment banking business. And that's why what happens, in the story trading forums and in my forums, and actually learning, and that word that I use, experts, okay? If you don't know anything about a supply chain management software system for automotive companies, you got to go find somebody who does, okay? Ideally, so that you have expert analysis of what you're invested in. Zero of the research that you're going to get from any broker is going to have any of that. Zero, zero, and zero. So you can't count on that at all.
Perfect. Daniel says he saw your face and he gets the point, I think. We got a question from Keith Resnick. When selling calls or puts against a position, how far out do you go on the expiration?
That's a little more art than science. I try not to go too far out, right? Because you're making a move based on a move. So, my stock goes from 10 to 15 real quick because traders heard something on Wall Street bets or whatever, and whatever it might be. and the thing's ripping and everybody wants to buy the calls, and so the premiums and the calls are high. Great. Okay, I want to lock in on some of that, but I don't want to go too far out on that because I believe in the stock. So the more time passes, the more likely it is that $15 is a sustainable price, right? Because if I'm selling calls, what I'm really doing is saying there is a chance that this $15 price does not sustain for a period of time. But after before long, it is. The 15 is something that can sustain, especially, I believe this stock is worth, like, I think Smith, and I've said this for a long time, I think Smith is worth 15, but I don't expect it to everybody to think that way immediately, right? And slowly but surely, the stock's gone from 1, 2, 3, now it's 7, right? There's a path that people take to it. So you have to kind of think about that when determining how far out you want to go. I rarely go out more than like 2 to 3 months, and generally, 1 to 2. And it's more arts and science. I'm looking at the various options and strike prices and saying what looks most juicy to me relative to what I think about this position.
Perfect. Rob, do you have any questions that were sent to you? Because the other two came direct message to me. You may have some there.
Yeah, I'm not seeing any direct to me, but I actually have another comment or question.
Sure.
So I've noticed, I've actually followed you for 7 years, and I remember back like 7 years ago, some of your stocks were a little, I would say, riskier, and they had more downsides, and maybe the risk reward wasn't as good. Like if we take APT and TPCS as an example, those are stocks that, like, APT came back to where it was, but the DCF and the fundamentals are so good, it's like holding its position. It's probably not going to go below that. Same with TPCS, solid fundamentals. Is that part of your strategy to find stocks that have upside, but they're also safe and that you probably won't take any losses on?
No, I'm always just looking for opportunities. And at any given point in time, the risk reward profile of those opportunities they're going to be what they are. It's going to be what it's going to be. So, you gave examples. I could give you examples, David's Tea, Summer Infant, names that I didn't necessarily talk about, Party City, things like that, companies that had an extreme level of risk. Okay. So I don't change my methodology over time. I do have, like, every year UBS is getting more and more of my money because as I make more money on my core, on what I do, I made another $1 million. Let me send that over to them because I can't manage extra millions of dollars. Here's another $1 million. Here's another $1 million. And keep sending it over there. My methodology doesn't change. I'm just looking for great opportunities, and some of them will have a great deal of, very, very low risk. And some of them will have a great deal of risk. I mean, Mogo has a tremendous amount of risk and a tremendous amount of upside. Very high risk, very high reward. TPCS less so, Smith less so. Some of the names earlier in this year more so. So no, there's no rhyme or reason to it. But I will say that during times of crisis, you'll find more high risk reward names. You'll tend to find them, and at levels like this where the market's really high. Lower risk stocks are going to be more prevalent, because if the market is so high, then you look at a Teladoc, look at how much risk there was there at recent levels. It was very high. So it just, see, a lot of what I outlined and the replay of this, I think what I would very much recommend, if you take notes, it's what I described sounds simple. It's kind of like Confucius, though. A lot of Confucius sayings, as I get older, I'm like, chew your food. That sounded so simplistic, but my Lord, it really makes a difference as you get older, that chewing your food is important. And I didn't think about that. Everything that I gave you right now is like chew your food. It might sound simple, but it comes from a place that's extraordinarily complex and boiled down to simplicity. And that really ends up a lot of times being the most powerful stuff. And people will underestimate how powerful something is. So go back, watch this again, and realize that as simple as this all sounds, executing it and the place that it comes from is much more intricate.
Great, Mark. There's a couple off-topic questions. Do you have a few minutes? What I'd like to do is close out this recording with the last couple slides here, and then take some of those offline. Does that sound good?
Sure. I've got 5 minutes and a hard stop in 5 minutes, and you got me
Perfect.
until then. Yep.
Awesome. So real quick, everyone, to follow Mark Gomes, you head over to, again, what was the website URL again?
It's Mark Gomes Stocks, MarkGomes. You see it on the screen. And then the word stocks. So there's going to be 2 S's in there. markgomesstocks.wordpress.com. Perfect.
And you can click on social media to find him on StockTwits, WhatsApp, Twitter. Also, his YouTube channel has been more active on recently.
And there is
yes.
And if I may, there is an article on that website that says how to follow my picks and methodology, and that will give you the full outline and instruction manual.
Great. And
Thanks.
at storytrading.com, you click on events, you can see the upcoming events we have. Our next one, we have one pretty much every Sunday night. And the Sunday night ones are usually reserved for VIP members. So if you'd like to become a VIP member, just go click on there, VIP. We have 2 new stock recommendations coming this Sunday night. You can find us on YouTube, Twitter, twitter.com/storytrading, YouTube, just type in story trading. And with that, we're going to end the recording, and we'll see you guys next time. Thank you.